Hey, good afternoon, everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick from the Cusick Group Securities offered by MoneyBlock. Here to talk about how you can hedge your portfolio using volatility, the VIX. Had quite a few requests come in about how you can utilize VIX to hedge your long portfolio. So I thought, let's do it, Strategy Now. Currently, right now, the volatility index is trading at 1140, down 20 cents or 1.18%. But you can see that the market in general has been basically waffling around flat to down today. You got the Russell up, NASDAQ, S&P 500, and Dow Jones all down right now. Volatility has been in a very determined range, basically between 11 and 12.5. So we haven't had a lot of vol expansion. As a matter of fact, it's been quite frustrating. There hasn't been any volatility. So with that being said, how can you actually hedge your portfolio or put volatility to work for you in case we have that event or that violent move, and specifically to the downside in the case of trying to hedge your portfolio? Now, putting this volatility component in your portfolio isn't going to hedge it completely, but at least it is a position that can offer you some sort of offset when the markets do start to turn, or if they do. So jumping over to my trading platform, I type in VIX. I scroll down to the options chains. Now, the one thing that you're going to notice is that currently right now they have VIX listed at 1128. That is what we refer to as the spot or cash VIX. And that is not the price that these options, the VIX options, are actually getting their pricing from. And that's not what they follow. They actually follow the VIX futures. Now, most platforms don't offer the VIX futures. But if you go to the CBOE.com website and go in, you can find delayed futures quotes for the VIX futures. Currently, the March VIX future, which is expiring on the 22nd, is trading at basically around $12. It's got 1188 to 1230. Then you have the various weekly VIX expirations, and you can go out as far as into November of 2017, all listed here. Okay, so I'm looking to put on a hedge not for the next 5 days, not for the next 7 days. I want to put it on for the next 30 days. I'm looking to take an opportunity to generate some potential value in my account if, in fact, the market does pull down, even if it's for a brief time. One way that you can do it is utilize the VIX options, and we're going to use it through a strategy called a bull call spread. Now, we've discussed this in Strategy Now. As a matter of fact, if you go back and you actually take a look at some previous Strategy Nows, you can actually find a discussion where we discuss the bull call spread. But a bull call spread is this. You're buying a call, and then you're selling another call against it. Now, you remember how I said those VIX futures for March, April are trading between $12 and $13. So now you see that, oh man, they don't all trade at the same price like stock does. For all the other option expirations. No, they don't. So in this case, I'm going to be looking for the April 19th expiration. The futures are currently trading at 1334. Now, if you look at an options chain and you're basically saying, oh, the VIX is trading at $11.30 or $11.28. I look at the April 19th, that's when they're expiring, $11.50 calls. They're trading for $2.30. That seems really expensive. That's where you got to look at the delta. The delta is telling you that these options are not generating their values from this price of $11.28. It's from another price. And how do you determine what that price is? Keep looking at the deltas. That's this column here. Basically, I know that the April options are pulling their value from the at-the-money strike option, which is basically the 50 delta option. So I look, and it basically is telling me that it's picking up its price somewhere between 12.5 and 13.5 bucks, right? These are the 50 to 41 delta option. So I'm going to basically say it's right wrapped around 13. So that's where I know where the value of the underlying that these options are deriving from it, by looking at for the at the money option, right? Okay, so good. So now that I know that the April options in VIX are trading around basically 13 and some change, and specifically if I go over to the CBOE, the futures that expire on the 19th of April, they're trading at 13.34. Great. So they're right around this area right here of 13. So I'm going to structure, and I always say if you're going to do a bull call spread or a debit spread in general, the strike that I'm going to buy is going to be about one strike in the money. In this case, I'm going to be looking at the 12.5 calls. So I click it once. Now I'm going to have to actually expand this because I'm going to need, if we're doing a call spread, I'm going to buy the 12.5 calls. So I click that once. And I'm going to sell another call against it. Which call do I sell? Somewhere between 20 and 30 delta is what I'm going to sell. And in this case, I'm going to sell the 18 calls. All right? They have a 20 delta, so that means that basically they have an 80% probability at this juncture of going out of the money at expiration. So basically what I'm doing is I'm buying the $12.5 calls, I'm selling the $18 calls, so I'm paying $145, I'm collecting $45, so net, I'm paying $1 per contract. Now let's put this in context. My break-even point is going to be the debit I pay plus my long strike price, so that's 13.5. Remember, the futures are trading right now at 13.34. So that means that if the VIX or the volatility, the April futures that are expiring on the 19th go to 13.50, I'm basically trading around break even. So I need a very nominal amount on the upside to get to bare minimum break even. But to get a little more sophisticated here, I'm actually going to add another leg. Let's say that I don't mind if I actually have a VIX or a volatility position. In other words, I get assigned. So if I click here, right, I'm going to sell the $12 puts and collect 30 cents. Now this is going to increase my risk, right? The reason why it's going to increase my risk is because if all of a sudden volatility continues to drop to the downside, I'm going to then be basically getting long volatility as it goes down. That's going to work against me. That's also going to increase your buying. You're actually going to have capital risk greater than $1 as what was represented in the debit spread. Now, I'm doing this, if you're more sophisticated, if you've ever sold a put before, you're basically selling a naked put is basically you saying that you are willing to take a long position. In this case with VIX, if you get assigned on the short put, that just means that you're going to have cash removed from your account. And right now, it's going to be you're going to have to put up a requirement of $1,200 per spread contract. What am I doing here? I'm buying the 12.5 call. I'm selling the 18 call. That's my bull call spread. Okay, right now that would cost me $1. Now I'm selling the 13 put or the 12 put. I collect another 30 cents. So that means that my net debit is no longer $1. It's going to be 70 cents. So I put in 70 cents, and that's my debit. So is that my total risk now with the new strategy? No. My total risk is going to be the 70 cents plus the $1,200. How did I get $1,200? I'm selling a naked put, so you take the strike price, you multiply that times 100. That's how much capital you have to have in your account per contract. So I'm putting up $1,270 worth of risk. What's my maximum profit? My maximum profit is the difference between the long and the short strike price of the call options. So in this case, if I pay 70 cents, my cost basis is right around $13.20. That means that if the market actually goes up to 18, right, I'm going to take in $4.80 or $480 per contract. So I'm risking $1,270. That's if volatility goes to zero, which if it does, then guess what? The markets are probably taking off and it's complete nirvana. But if it goes to 18, I make $480. All you have to do is go review order and then place it. But of course, I do have to put in a number of contracts. Now again, if you have a smaller account, putting $1,200 towards a position may not be worth it. So just remove one of the legs, right? So I'm going to remove that leg, and then you could just put the bull call contract at $1. I just wanted to show some of you some other sophisticated ways that you could actually do this strategy. I'll review the order. So I'm going to buy the $12.50 calls. I'm going to sell the April $18 calls. I pay $1. That's my risk. My maximum reward is the long strike price plus the premium, right? That's 13.5. Then minus 18. So you have $4.50 or $450 if in fact volatility expires in April at or above 18. Now, can you take this order off at any point in time? Of course. That's the beauty of all of this. And you can see I was filled. I was filled at 95 cents. So I actually got filled a little bit better. Okay, folks. Well, that's it right now for our strategy now discussion on how we could use volatility using a bull call spread, and then even offset that bull call spread purchase price. We could sell an out of the money put that is cash secured. And we are basically set up so that if volatility increases and pops, we have a small hedge against our portfolio. And in this case, it'll bring in $450 per contract on the spread that we purchased. If, in fact, we did the spread with a short put, basically it would bring in $490 against basically $1,270 worth of risk. So that's it. All right, folks, join me at 3:30 Eastern Time for Tech Talk. We're going to talk about some stocks that are going to have some earnings. We'll talk about where they're going to move, where they could potentially move, and give you some transparency using charts and option analysis. We'll see you at 3:30 Eastern Time here at MarketStream.live.